All right, we're going to call our meeting to order for Wednesday, July 5th, 1 o'clock. The invocation will be led by Commissioner Pickens and the Pledge of Allegiance by Commissioner Lible. Please stand.
Let us join together as you go to the Lord in prayer. Our Heavenly Father, we just bow our heads to thank you for this glorious day you've given us, Father God, and all the wonders in it. Father God, we just ask for guidance today and input, information, Father God, for the county business that's at hand, Father God. Just bless us and our continued service. In Jesus Christ we pray. Amen.
Amen.
Please join me in the pledge.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right, thank you very much. And we will start with our agenda item, report from Benji Bates, fully insured versus self-insured health insurance. Mr. Bates, you have the floor, sir.
If I might just set the stage real quickly, just for the record, so we're all on the same page. As I'm sure everybody will remember, this board, back at its last regular board meeting, I believe it was, approved moving forward with the Florida Blue fully insured proposal for the employee health insurance. It was then at a later meeting, specifically to discuss insurance, that it was determined that you all wanted to take a look a little more closely at the options for health insurance, whether they be fully insured or self-insured. And with that, Ms. Allen, our Director of HR, has gotten with Florida Blue's representative at the Bates Company to ask them here today, along with a representative from Florida Blue, to discuss those options with you. And that's what we'll be going over today, and hopefully be able to set some rates and decide, you know, which way the county wants to go.
Good. Thank you. Thank you very much, Mr. Mann.
Good afternoon. How's everybody? Hopefully everybody had a good Fourth. Yep. There's two documents in your packet, and we've done two different scenarios for you. We'll start with the larger of the two that in red says current enrollment with new rates. So the larger of the two, and we'll walk you through that here.
Both of them fully insured?
Sir?
Both of them fully insured?
We start with fully insured. So the larger of the two. Yeah. Yes, sir. So we have two, one's larger, one's smaller. So when you look at the larger of the two, this shows our projected, this shows where we are with current enrollment with the new fully insured rates from the RFP. And as you can see that, we get an all-in number of $5.2 million moving forward. So that's just to kind of set the baseline where we are with that. Then on the next few pages, we go into the self-funded numbers. And we'll talk a little bit about claims because I've heard different numbers being dispelled. In self-funding, we know certain are fixed cost, and that would be in the first table there where we look at our administration, our specific and aggregate stop loss. Those are our fixed cost, our known cost. You can see that number is $779,000 there. Then we get into the claims amount, and that's what I want to talk to you for a little bit about, and I also have some data to back that up. In the proposal, you had a maximum amount and an expected amount. And that comes from, and Jim can come to speak in this and help me with this if you need him to answer this, but they're looking at what we expect claims to be and then what they could be maximum. In the maximum amount, once the claims hit that $5 million, you bought reinsurance, the aggregate, it pays claim over that. But I want to talk a little bit about the probability of hitting expected. So we did some number crunching, and if you look at this bar graph that kind of has this bell curve, see that bell curve graph? This is our probability that we hit expected. And we worked all through the weekend to get this, and our expected number, and this is from Wakely, there's a 50-50 chance you hit expected. So there's a 50% chance that you hit expected and the claims are better, and there's a 50% chance that the claims are worse than expected. So that, to me, is not a gamble that, or a risk the county can take at this time. If we look and we say, where do we think things would be, we can extrapolate that a little farther. And just to give you some numbers, there's a 28% chance that it's 105. Now, as I said in the last meeting about a week and a half ago, I felt confident you wouldn't hit maximum, and the chances of hitting maximum are 0.5%. So that's our probability of where we expect claims to be. And to say that is to say that we do not feel comfortable with this group using the expected amount as a basis for funding, because there's a 50% chance it could be right and there's a 50% chance it could be wrong. So what we did was we took a different approach to that, and we took the expected claims and we trended those 8%. We're hedging against that uncertainty. And that's where that green bar comes in at the 8%. And then you can see here, we then compared these numbers to fully insured at the maximum, at the expected amount, and then at our aggregate. To kind of show you some percentages of savings or cost increases to fully insured, and then also as a total dollar amount. So what we wanted to do was, on a big picture, do a comparison of self-funded versus fully insured with the numbers from the proposal, because there's been some discrepancies there. But then also give you that bit of caution. We know, or, again, actuarial data says it's a 50-50 chance we're going to blend it expected, and we don't feel using expected to be a smart play, because again, this is a long-term decision, and we're not even talking about the implications 12 months from now. And with that, I think when we look, and I also threw in, to further back that up, I threw in, and I know a lot of people have seen it, the regression analysis, which is that chart that looks at the county's claim over the last 2 years. And I know I've talked about this a lot, but this still goes back to illustrate the point: there is volatility and there is fluctuation in this group with the claims. At this point in time, you have no high-cost claims that would hit the spec amount. A year ago, there were 5. So we believe you have to take into account that volatility and hedge against that, and that's why we gave you that scenario. And that's in scenario 1. The smaller font scenario is, that was just an illustrative purpose, just to show you what could possibly happen, because we know we have a third plan out there, a new plan, a 5301. So what happens if everybody in the current buy-up plan goes to the 5301? What does that look like? So that simulation was on the smaller of the two. And in that simulation, we even gave self-funding a little more credit and trended at 6%. And even at that point, actually self-funding ends up coming in higher than the fully insured under that simulation experience with the county. So as I've always said, we're not pro or against any one thing, but we're for proper decisions and hedging against uncertainty. And we tried to lay it out with some charts, some probability of where claims could and could not fall. And that bell curve chart explains that, or gives, to me, I'm a visual guy, so it shows where we are visually. And then I think Ann has rates, just to see if you want to look at the micro level, where we're at from a fully insured versus an expected on what rates could look like. But again, when you see that, statistically, there's a 50-50 chance those rates are going to hold up. So hypothetically, so then what happens? So we get into it, things run great, then the plan, we don't need it. But if the 50% that, hey, we had some increase in high-cost claimants, claims shot up, it goes the other way, then I've got to come back in front of you guys and say, hey, guys, we're not at expected. We need $300,000, $400,000, $500,000, whatever that number is, transferred into the insurance fund, and then that would have to be approved and moved in a quick manner to get things back on track. And as I've always said, when I'm hearing there's less than $2 million, or when the county has dwindling reserves, that's not a situation that I want to come back and ask for that to properly fund a program when we don't have a surplus of reserves at the current time.
Mr. Bates, do you have those rates, those projected rates?
Ms. Allen has them.
Can we stop for just a minute, Mr. Chairman,
Sure.
and talk about what Mr. Bates had just shared with us? My concern last week and again this week is under the self-insurance plan, if he were to come back with such a, you don't like Mr. Pickens too much, do you?
At least not his name tag.
Here, throw mine down just to prove it.
I think that that's key to our discussion today is a safeguard to those increases. What if he does come back with a $400,000 or $500,000 request? What kind of contingency do we have? I mean, I've been fully insured for that exact reason. It all lies there. If we don't have a backup plan, if it does go south, so to speak, what do we do? I mean, it's a legitimate question.
Well, I think that you're right. The backup needs to be there. We can buy plenty of reinsurance to help us through some of this. There's a 50-50 chance. This is driving it out of necessity, because if we don't fund these premiums properly, then they're going to be on the backs of our employees. And that's my biggest concern. Commissioner, if you find the $1 million on that we can plug into self-insured, I'm sure Benji would love to have an extra $1 million in expected claims at the end of a year. And I think that would drive our 50-50 chance all the way down to a lot less than that. So I think there's room here. I just think that if we're looking at saving dollars, we've got to look at the self-insurance, because that was a big bite of the apple that we took.
You didn't do anything to send to ease my concern about the risk. I'm sorry.
I
You
hear
did.
you.
I
hear
mean,
you.
Ms. Papel, can you help that? I mean, is there,
Are you ready for my part?
Well, I think that's where the conversation.
key question.
So, yeah, we got to know what
really
the,
is.
what the county contribution is going to be. I mean, I think that's a big concern.
It is.
Yeah.
You know, failure's not an option.
Thank you. Well, not yet, thank you now. Well,
Thank you.
I have 3 scenarios here. This is looking at what I believe was the direction you guys sent us in, and that's funding, the county funding some kind of rate structure against the core plan, and anybody that wants either of the 2 higher plans, that increment on them. So just looking at the impact to the general fund, I carved out 3 scenarios. Any way we distribute the rates, the difference between the full insurance rates and the 50-50 chance self-insurance
Call it
rates
self-insured, please.
is, well, there's
It's not a
different
50.
self-insurance rates that I just got too.
Okay.
So this is at the expected. The difference is $304,395 up front. In these scenarios, the county's taking all the risk. If we don't set the rates to where we're trending, or to where we buy enough reinsurance that we're guaranteed not to have exposure, there's virtually no savings. Here, at the expected, the bell curve that Benji showed, there's a 50-50 chance, but if we go over, the county incurs all of the expense because the rates aren't distributed among between the county and the employee. Now I've got the distribution.
That's what I need to see.
on all three of these. Okay,
You can pass that out.
I shall.
Does that graph show us the current, what we're currently doing to what the projected will be in this coming fiscal year? What we're currently on county contribution?
Yes.
Okay.
I've got a page for each scenario, so bear with me. This is scenario one. Scenario two. They're numbered at the top. The scenario. Also, Mr. Manning asked me this morning, and I prepared another scenario, and that's if we went with the 8% trend, and that would be this one. And as you can see with these scenario 1, 2, and 3, the impact to the general fund, any way you look at it, is level. So I only did the 8% trend on scenario number 1.
Thank you.
There. Oh, did I keep one for myself? But grab one quick. All right, now let me go over these with you.
Please.
The first piece of paper, the one that looks white, yellow, white, that has scenario 1, 2, and 3 on it. That's using, like I said, in each of the boxes, there's 3 boxes, 3 scenarios. The top half of the box is full insurance. The bottom half of the box is self-insurance using the expected rates, which, as Mr. Bates just said, is a 50-50 chance that we are over or under. Full insurance would cost the general fund based on the current, keeping the current percentage of singles, the current percentage of single spouse plus spouse, the current percentage of single plus children, the current percentage of family, keeping all those the same. The expected cost to the general fund on scenario number 1 is $3,382,119. What I've put back into the budget is $3,332,497. It leaves us a shortage of $49,682, which can be funded by the $50,000 wellness amount, if that's the one you choose. It doesn't give us any margin for error.
Okay, before we go any further,
Okay,
this current year,
yes.
the county contributions were $4.7 million.
My whole analysis is impact to general fund.
I hear you. That's gonna be that's the big bite of the apple we're talking about.
Right. So my whole analysis is apples to apples to apples to apples, all looking at impact to general fund. Once I know what I have to work with in the general fund, I can carry it to the other funds, and I can budget the insurance fund the whole amount, whatever that whole ends up being.
But we're still not there yet. We're still not knowing what that number, that whole amount would be. Let's just say that we wanted to keep the funding the same as we did this current year. We've got to find about $1.5 million to make that happen.
In scenario number one, if you went full insurance, if you went self-insurance at the expected, which is the 50-50 chance, that general fund cost is $3,077,724. The difference between full insurance and that level of self-insurance is $304,395. With the county incurring all risk, should it be more expensive, all reward, should it be less expensive. Similarly, in scenario number two, which is the one I'm recommending, you have a full insurance cost of $3,362,431, which is just $29,994 more than I budgeted. It allows being covered with the $50,000 wellness amount, a $20,000 margin for error, and money left that could be used for a wellness incentive devised and implemented towards the end of the year as we go into next year's insurance planning. Again, at that level of self-insurance, you're talking about $304,395 less expensive if you go self-insurance, but you're at the 50-50 risk. Similarly, scenario number three, that cost is $3,359,980 for self-insurance, which is $27,543 more than I budgeted, leaves us a $22.5 thousand margin for error. Still, full insurance, only $304,395 more than self-insurance. I handed you 3 pieces of paper that tie to each of these scenarios, 1, 2, and 3, that show you what the rates would be, no matter which plan you choose, on full insurance or self-insurance. I also showed what the rates were prior year is this year, because we're looking at budgeting next year. And so this year is the prior year to next year, just so you understand why I called it prior year. The increase or decrease. Out to the far right, I also showed the rates for the buy-up plan against the Core Plus plan. Again, I'm recommending scenario 2. The last piece of paper, which is 2 pieces of paper stapled together, are what Mr. Manning asked me to produce this morning. That's, again, the full insurance. I just took scenario 1 because it's going to be the same amount in between the 2 insurances, between any scenario we choose. It's just changing the amount of the premiums we collect for self-insurance. Taking the rates I had for the 50-50 and then adding 8% for the 8% trend, as he instructed. I came up with rates that end up saving the general fund $20,148 only to go self-insurance rather than full insurance. And the rates on the next page, in some cases for self-insurance, are higher than for full insurance, as Mr. Bates stated. I didn't produce any more sheets, but I did come up with a number for 4% and a number for 6%. 4% saves us a little over $150,000 if we go self-insurance rather than full insurance. And 6% saves us plus or minus $85,000. But as you lower the percentage over expected that you buy insurance for, you're increasing the risk.
All right, so you're recommending scenario number 2.
Full
fully
insurance.
insured,
That's what I'm recommending.
Right? So tell me the impact of this scenario to the employees from this current year to the next fiscal year.
Okay, that would be scenario number 2. Scenario number 2, this is what I did with the rates, because I was trying lots of different ways looking at them. This is not paying 100% of the single rate. It's paying all but $3.50 of the single monthly rate. It's paying, let me get it here. It's paying all but $1 of the core dental rate and all but 50 cents of the vision rate. So a single employee on the core plan to have health, medical, well, medical health, same thing, dental, vision, will cost that employee roughly $5 a month.
Okay.
The scenario number 2 just shows you health, but when you extrapolate it out, it would cost the employee roughly the single employee roughly $5 a month. I don't have dental and vision worked in for the rest of the levels, but on health insurance, the employee plus spouse on a core plan would pay an additional $20 a week. The employee plus child or children on the core plan would be another $15 a week, and the family would be another $50 a week, so $200 a month, which is slightly less than the 50% option that I presented you last week. Now, if an employee chooses the Core Plus plan or the buy-up plan, it's a little more expensive because the county, as the direction I was given through the insurance committee meetings and the last time we met, that's letting any additional cost for Core Plus or buy-up be incurred by the employee.
All right. So just to get this straight, 5302 with the $10 generic, is that also included the problem with the imaging that we seem to have? Is that included in that 5302 with the $10 generic?
You'll have to ask them.
Florida Blue? You might want to come up for the record. Because I think that was the stumbling block. We had two issues. One was prescriptions and one was imaging. And we've been hearing that through this presentation.
Could you repeat the question, please?
The question is, does the 5302 with the $10 generic choice RX plan take care of the problem we've been having with the imaging situation here in the county?
Our prescription brand meds.
Two different questions.
Two different
brand.
questions, yeah, two different questions.
Two different questions. So the current 5302 currently is calendar year co-insurance for advanced imaging at independent diagnostic testing facilities outside of the hospital. Based on discussions that occurred post RFP, it was brought to our attention that that was a concern, that a request was made to turn that into a co-payment versus a calendar year deductible and co-insurance. We already confirmed that it was changed to a $150 co-payment
Okay.
on the buy-up plan. And I can confirm today that it is on the base plan as well. We will make it a $150 co-payment. So all three plans now will be a $150 co-payment for advanced imaging at independent diagnostic testing facilities.
And, okay, that answers my question.
Okay.
Commissioner Lible, you had a question about?
Name brand prescriptions
That-
on the buyout plan or the core plan plus. Or the core plus plan is what they call it.
So the 5302 that you have today will remain as is with the generic-only coverage. The, I believe you're calling it the Core Plus
Plus
plan,
plan.
does include coverage for brand name medications.
Okay.
With
Yes,
a
sir.
$60 copay and a $100 copay?
Yes, sir, and that's how we responded to that one in the RFP.
Thank you.
Oh, sure. Any other questions? Okay, thank you.
Thank you, sir. So back to you, Ms. Vappel, real quickly.
Certainly.
The impact to our employees, the maximum impact, let's just say family, for example, would be the highest one. And that would be a $50 per week, $200 a month.
Core plan to core plan.
Core plan to core plan.
Now, should a family that's on the buy-up plan now
Right.
want to
right.
stay on the buy-up plan, it would be $136.70. Should a employee on the family buy-up plan now want to drop down to the 5301 Core Plus plan, it's $71.90.
But one could anticipate if they're on the buy-up plan now, and we enhance the medications, the the drugs, they would go to the Core Plus plan, they could, and they could possibly see a savings by doing that. Am I?
Absolutely, should an employee decide to drop from the buy-up plan to the Core Plus plan, there should be,
It would,
that decision will be a cost-saving decision.
but I think, from my understanding, the employees that went to the buy-up plan had to have better coverage on the prescriptions and things like that.
I'm not privy to any of that, that's all HIPAA.
Yeah, I understand that, but I believe that was one of the concerns. What would you say, Ms. Allen?
Yes.
You might want to grab the mic.
That was one of the concerns we were hearing, the generic only on the core plan versus the buy-up plan, having out-of-network benefits as well as brand prescriptions. And the committee requested that we go out to bid and include a mid-range, or what we're calling our Core Plus plan, that has generic prescriptions as well as brand. And now we're hearing that the diagnostic imaging has been improved. So that's a good thing.
Seems like by going to bid, we saved, what, 4%? And we also, 3%, and we got some concessions made on the imaging. So I think we solved some of the problem. Commissioners, I've been kind of hogging the conversation. I apologize. So if you have any questions, comments?
I know it's a lot of numbers to look at once.
Well,
What prompted this segment of the conversation, though, was that contingency. Again, you know, if we go self-insured and we have a hiccup, I think the question kind of got moved over to you, and you did the handouts here, but as a budget officer, do you have any?
As a budget officer, I continue to urge you to defer the going to self-insurance until we can create a contingency, and I have already prepared the forecast that you asked to be shown Friday. that shows how we can get from here to there with
Very
our
good.
fund balance. But I don't think here is today.
Will you have that for Friday's discussion?
I do.
Okay,
Actually, we'll get that a little bit before.
that's all I asked for.
Okay. All right, any other questions?
I'm just going to make a comment.
Please do.
Thank you. Thank you very much.
You're welcome.
I know that you've spent lots and lots of hours on this. This makes me feel a lot better. It's not near as far out of whack as I originally had seen. So yes, thank you very much.
Well, I believe it allows us to take, that's still that big bite of the apple, if you will, that I keep referring to. And it doesn't hurt our employees, and none of us wanted that to happen. So I think when you look at that, that was all of our concerns. And I'm glad we were having the debate, and I'm glad we were having the meetings to go along with that, based on that, because it's important that we get this right.
Well, I just want to make sure everybody understands that the scenario number 2 that I'm recommending, we are not funding 100% of anyone's medical, not even singles. We're not funding 100% of anyone's dental, and we're not funding 100% of anyone's vision. But we are, the single employee can have all 3 insurances for $5 a month.
$5 a week, you meant,
Yeah, $5 a week.
yeah.
But you're right, that's exactly what I meant.
Which is, I mean, it's affordable. You know, Pepsis are $1.39 at the Handy Way. So it's affordable. I mean, it's, you know, it is what it is, and we've got to be able to help all of our employees at this point, so. All right.
Mr.
We've
Chairman,
been-
let's, if we can, let's go over the family plan,
Okay,
weekly or monthly, I don't care, but let's give it the same scrutiny we just did the single employee,
well,
or discussion, I don't care.
okay. Well, we kind of went over that at the
Okay.
$50.
Yeah, but it still isn't clear.
For core,
Let's stay out of the buyout plan and just go to
The core plan?
the Core Plus plan.
Or
okay,
plus
for
plan?
the Core Plus plan, a family would pay $732.28 a month, which is $365.64 on a biweekly payroll, or $182.82 on a weekly payroll. Now, we're just talking health. We're not talking dental or vision here at all. Just health, $182.82 a week, which is $71.90 more than they were paying this year
Per week.
per week. Assuming that they're moving from the buy-up plan to the Core Plus plan.
I think the biggest one, if you look at it, is what we currently have now. The buy-up plan is the biggest hit at the $136.70 a week. But if they can come down to the Core Plus plan,
They can almost cut that increase in half.
there's a potential savings from this year to next year. If it works for them. That's a decision that they'll make based on their, Commissioner Lible, I'm sorry, you still have the floor, sir.
No, go ahead, no, ahead. I just, in your explanation just a minute ago, you said from the buyout plan to the Core Plus plan. You meant from the Core plan to the Core Plus plan.
No, I really did mean from the buy-up to, say somebody right now is on the buy-up plan, family. Okay, then their contribution is $110.92 a week. And they decide to drop to the Core Plus plan, their contribution is instead going to be $182.82 a week,
I think you got the numbers.
which is an increase of $71.90.
Okay.
Okay? Now, if somebody's on the core plan now, they're paying $46.50 a week, and they're going to move to $182.82. They're getting a richer benefit. And they'll be paying that difference. I don't have it in front of me. I didn't calculate going up from the core to a higher plan.
Question just came to mind. On our mail order prescription that I currently use, give that to Miss Allen real quick. Does it cover the generic drugs too? I mean, the name brand drugs? I'm sorry.
If it's part of your plan, yes, sir. If
Okay.
you have a plan that has the by mail.
You know, naturally, we
Brand.
all want to shop locally, and I took my current prescriptions to the local pharmacy and said, can you match them? And from the mail order, and because I didn't want to leave our current pharmacy here locally, but they couldn't do it, and they encouraged me to go to the mail order. And it really has worked. With my flexible savings account, it really worked well, frankly, so. I mean, I think that's a story, maybe I can put it in writing and articulate it better where the employees can see it, what it actually did for me and my situation, me and my wife, so.
This scenario number 2 is my best attempt at making everybody happy. You know, it's
can see that.
less expensive than the 50% option I presented last week for the employee. Everybody has skin in the game. And it leaves us a $20,000 margin for error.
And we didn't saddle the employees with all the, just the cost that it was going to be at the beginning of the contract.
Well, I mean, the biggest change between last year and this year is embracing the philosophy that we make our funding decision on the core plan, and anybody that wants either of the 2 other plans pays the incremental increase. That was the biggest change.
Well, and also, we want to give good health insurance to our employees, and with the changes that were made by Florida Blue, it appears that now we have a product that can pretty much fit the need at the core plan level that addresses the concerns that we were hearing from our employees. And that's what excites me on that.
I think they've worked hard to bring us good business.
I'm glad.
Yeah.
Yeah, that's good. That's good. All right. So I think we've talked about number 4, the county contributions towards, if we go with scenario 2, on the fully insured that you're recommending, we know the county contributions toward all insurance, right? Or we're still talking vision and dental, we got to get there.
Well, I mean, there's multiple scenarios. I mean, traditionally, with dental and vision, we only have funded at the single rate, and so anybody that's what we're giving, and if you want to add children or family or spouse, all the additional is your choice. Same with vision. This, instead of having,
But those rates came down also, didn't
they came down also, and this is the core single dental rate less $1, and the single vision rate less 50 cents. So we're talking, let me find the numbers. They're not jumping out. So 408 of 458 for the single, and 1990 of $20.90, again, at the single rate. There's a buy-up dental plan, so we've got 8 different potential dental levels, and we've got 4, we would have had another 10 or 12 handouts, so I'm just trying to keep it.
All right, commissioners, you've heard all the presentation. We have went around this a lot, and I appreciate your patience with this. What's your pleasure? We got to give Ms. Papel some direction. Mr. Administrator, any final comments on this prior to us?
Obviously, this has been a difficult task, and I appreciate everybody putting in the time and effort.
You really
thought,
have.
From staff to you all to everybody else that has participated, those in the public as well. It's certainly a difficult choice. Health insurance costs have skyrocketed. I think we've seen that in every sector of our society. Unfortunately, we're as a county in a very difficult position financially right now. So it makes it, very hard to absorb those increases. And I think, as I said, I think everybody's worked real hard to try to do as much as we can from an administrative perspective. I'm going to have to agree with both Ms. Papel and what Mr. Bates has indicated. I think it's quite risky to go, if you were to go self-insured. I think there's a risk in that. I think that risk is even greater if we go self-insured based upon the expected costs, expected usage, where it could be 50% more, it could be 50% less. I think if you all are considering that, we really need to consider the 8% trending and look at what the cost would be, and it doesn't appear there'd be really a great savings in doing so. And in my opinion, that savings compared to the risk, it just doesn't make sense. We don't have the reserves to cover it if something does happen and we go over that. And unfortunately, that's the situation we're in now. So,
Thank you. All right. Commissioners, what's your pleasure? Mr. Sheriff, come on up, please.
You'll have to excuse me, I didn't bring my glasses, so I may have difficulty reading the small print on some of these spreadsheets, but I just want to be certain that whenever the commission takes this up for deliberation, that we're comparing apples to apples and not apples to dump trucks here. If you consider now that an employee on the core plan with family coverage pays $186 a month, as opposed to the proposed rates in scenario 2, that employee will now pay $386 per month for the same coverage. So we're right back where we were a week ago. We haven't made any forward progress. These spreadsheets look nice. I appreciate Ms. Papel's concern for the budget, but we've got to look at this from both the micro and the macro level. Certainly it's your responsibility as a governing body to look at this from the macro level, but it's also our responsibility to look at it from the micro level and consider what the impact is on our employees here. I have to give credit where credit is due. Certainly Bates and Hewitt has done their very best to negotiate and advocate on our behalf with Blue Cross, and we certainly appreciate all their efforts. I think what they've brought us back is a product that was much better than what we had last year, and I think they should certainly be commended for their efforts there. But I'm here also to express my anger, frustration, and concern for this county. I can't say with certainty whether it was ignorance or deliberate indifference on the part of staff, specifically the Human Resources Director who got us in this position, but this is the second year in a row, and also several narrow misses that we've had in not so recent years with this insurance debacle that we've been facing. It's unacceptable. This is all while we're being told repeatedly that we needed to self-insure. And let me be clear. Our employees don't care whether we self-insure or whether we're fully insured. That's not my decision to make, and it's certainly one that you're charged with making that decision. But to expect an employee to pay over a 100% increase for core coverage, I think is absolutely ludicrous. We're nearing the end of the budget cycle now, and I understand we have a meeting on Friday, but I've yet to see a proposed budget for any of us so that we can make an informed decision about how we approach this. I would implore each of you to be very thoughtful and deliberate, and to have the moral courage to make the right decision for the county, whatever that decision may be. Especially considering that how you vote today could place the county on the precipice of a disaster where we'll be one misstep away from complete failure. Again, it's, at least for my employees, it's completely unacceptable, and I think I can speak and advocate for the rest of the employees at the county as well. A rate increase like this will be absolutely devastating, not only at the sheriff's office, but at the rest of the constitutional offices and at each of the departments that report directly to Mr. Manning as interim county administrator now. And I give you my word that I'll do everything in my power to protect our employees and to advocate for their needs. So I encourage you again to please give this the due consideration that it needs. We've been running around in circles, haven't really came to any meaningful conclusion. Again, because I feel like the insurance committee and this commission was misled, whether it was intentional or unintentional, by human resources staff who hyperinflated numbers to further their own agenda perhaps. So please take that into consideration whenever you take this matter up for a vote.
Sheriff, I have a question for you. What scenario works best for you that you saw today for your department?
To be candid with you, I said I didn't bring my glasses, and I really haven't had an opportunity to study these. I don't see any of them that I've been able to look at thus far that will satisfy our needs.
Okay. Now, you have submitted a budget, and my understanding is that's an increase over last year. And there's no consideration of cutting that budget on our end of the, if we can help it. Is that correct?
Well, it's my understanding from talking to Ms. Papel that what she proposes is a reduction in our budget of a little over $300,000 for insurance, of which my employees will see no measurable benefit from. Not to mention, we're also going to be saddled with the additional burden of providing for life, dental, and vision that we were previously not responsible for.
All right. Let me let Ms. Papel answer that question too.
First, the only money proposed to reduce your budget is the $300,000 related to capital projects. And second, that average number that you got in the past was supposed to have included the employee part of each one of those insurances, life, vision, dental, and health. That average budget number that you were given in the past included each of those components. And so just because we're going to remit on actuals this year with an average number for fees and life, the largest component of which is life, you have always been paying for those things.
Please, Denise, come on up here to the microphone, please. Thank you.
Unbeknownst to
Oh,
us,
got to get to the microphone.
unbeknownst to us, we were not aware that we were not funding the life, dental,
Right.
and vision at the rate that needed to be done. So we literally had not really been paying for that. It was not budgeted because, as you stated, we did not, what we were sending into the county did not offset the life, dental, and vision.
The problem was, it was an average number,
Right?
and everybody was remitting on that average only based on either filled positions or only the position might be filled and they declined the insurance, but they still took the dental, they still took the vision, and by all means, they had the life in most cases. I understand that there are a few employees that decline life insurance.
But the bottom line is that it will be an additional cost, you know, on top of the 300,000 that's being taken.
It should work out to exactly what you budget or less. This shouldn't be additional. Based on the averages, this shouldn't cost any more than what you budgeted.
We only budgeted $1,536,000 on
You
health
budgeted
insurance.
$7,800 an employee,
For,
filled positions.
I used the figures that you asked me to use, which was last year, which was 197, which is $1,536,000 approximately. So if you add all of that up, we're not gonna come close to being able to, you know, pay for that and get the.
You should.
Not with the 300,000 that's gonna be taken out. And we didn't actually include the 300, the entire 300,000 capital. I didn't add that back in. It was, we were actually trying to look to the future and what we had to be able to in the past to pay for capital projects. We didn't actually increase our budget by 300,000 for capital projects for the entire amount.
My understanding is that you had a new roof in the budget and a laundry and something else.
We were not asking for additional 300,000. We were actually trying to save money. We were gonna save some more money to be able to pay for those. We didn't actually put the whole 300,000 in the budget.
So Denise, let me ask you this. Have you had a chance to look at these scenarios, and what do you recommend?
No, I mean, the money, I understand, you know, what, Mr. Bates has done, and he has done a phenomenal job. The bottom line is funding as far as the county goes, being able to fund that. And I just don't see how we're gonna be able to help out the employee to that extent that needs to be done in our budget.
And I understand what you're saying as well, Ms. Papel. You know, in the past, we were given a magic number, and that's how we budgeted for those positions in the insurance. But based on our calculations, we anticipate that it's going to place an additional burden of about $128,000 on our budget. Again, we've gotten off topic just a bit, but certainly we can take this up in the budget workshop later on. But that's an additional concern that I have.
Well, your concern is valid, and we do not want to hurt anybody at this point, but we are going to have to come to a decision today.
I understand that, and trust me, I wouldn't want to be in your shoes right now, not for all the tea in China. I hope that all of you have the wisdom and the moral courage, and I believe that each of you do, to make a decision that's good for the county and that's good for our employees, and that will move us forward and get us out of this hole.
Thank you, Sheriff. We
Thank you.
appreciate your time. I see.
If I might for a second, could you clarify which scenario, or is it scenario one that equates to what's currently being funded, if nothing were to change?
None of the
Current year funding.
None of the scenarios have extra money over the core amount for Core Plus or buy-up. None of the scenarios have that.
Okay, so none of these shows, it shows a scenario which would be equivalent to what the county is currently providing?
Right.
No,
Okay. Do we know what a figure?
no, but it would be much, much larger than what I budgeted, because the scenario number one allows me to break even with no contingency.
Do you have a very rough estimate of what that might look like?
It could be
Very
another-
rough.
It could be another $1 million.
Okay.
It's another 1.5 million or somewhere in that area. It's quite a bit.
Yeah.
We took a big bite when we tried to cut this cost down. But that comes with, Ms. Myers, you had your hand up. I apologize. I'm sorry.
It's been a long journey.
Yes, it has.
Mr. Chairman, Commissioners, Linda Myers, Tax Collector. I've been on this journey with everyone in the room as well as you all, and it is an awesome responsibility you're carrying. I just need some clarification. Along this journey, I thought the decision today was going to be doing a comparison on rates and making a fully funded versus a self-funded decision, but that the decision on what the county could contribute would be a decision based on the budget numbers that we receive on this coming Friday, such that you have other tools in your tool chest to bring to the table. So just to clarify, I thought today was, in fact, I remember the vote, it was, do we want to pull this vote off the table because we may not be able to get a fully funded or insured a second vote? And that's what today was for, fully funded rates versus self-funded rates. What's the best decision? But I think you still have the opportunity to look at your tool chest at the budget and come up with the opportunity to provide a less of an impact to our families.
And I understood it just like that also.
So if that's not the case, I think we all need to know the case.
That's the case.
That's the case. So today is a fully funded, self-funded decision.
We've already voted to go fully funded.
Correct,
Today was talking about whether we should go look at the self-insured even more.
Correct.
And I think that ship has sailed, so.
Okay, that's the call. And so again, on Friday, we'll be meeting to see if there's any opportunity to find another source of revenue or budget decisions. You had a couple of scenarios: reduce expenses or look at other revenue changes.
You know, Ms. Myers, I'm glad you said that. What I see Friday happening is big papers on the wall, and us starting with a deficit that we basically have, and starting to add and subtract until we get to a pleasure where we can afford it.
Sounds
And
good.
that's where I see Friday's meeting going, and what scenario best fits with those numbers at that point.
Well, and I certainly look forward to that, and as has said, encourage you to find the opportunities that are needed to make sure we have a sound workforce. Thank you.
Thank you. Mr. Tompkins, I saw your hand up over there.
Thank you, Mr. Chairman. Press Tompkins, Public Works
Thank you, sir.
Director. I'm just trying to get some clarification on the numbers. If we're looking at the fully insured scenario 2 family plan,
Okay.
we're talking $386 a month plus dental, vision, and life insurance per employee. Is that correct?
Correct.
Okay. That's what I keep iterating. My employees basically make $1,600 a month. You're asking them to pay a fourth of their monthly income for insurance. They can't afford that. I've said this numerous times, and I keep saying a broken record, but these guys only make $9, $10, $11 an hour. They can't afford a fourth of their pay to go to insurance. We've got to do something to help them out. I realize you ask them to pay $20 a month. I don't think that's going to kill anybody. But if you ask them, for a majority of them that want to have family insurance, you're talking $386 plus another $50, $60, $80, $100 more a month. They can't afford it. And I'm not the only one. Parks and Rec they have lower paid employees than I do. We're all in the same boat. And I just implore you, we've got to do something for our employees.
What's your,
I don't have a solution. I just got these basic numbers today. I'm like everybody else. I've been in the dark. I get numbers 2 minutes before a meeting. I haven't had time to analyze any of this. And we're trying to go through budget talks now. I don't know where I can or can't cut budget. I don't know what my final budget is to be able to explain or see where I may be able to cut some monies. I don't know that yet. But I'm just saying, the vast majority of public works employees cannot afford this.
so you're saying that if a family was insured under the core plan at Public Works, 5302 with a $10 generic, and they saw a rate increase of $50 a week, that would put them over, plus the $50 a week plus, plus dental, plus vision.
It's
plus
over
Well,
$50 a week.
It's more than 50. You're talking $386 a month. That's 70, what?
Well, it's an increase. We're looking at the increase off to
I'm
the
looking
right.
at the increase because the rate is that 1,300. Yeah, it's $100 a month. 200 if
That's
you do
$200 a
everything.
month.
I'm at
for the medical, not counting the dental, the vision, and the
I mean,
like.
if I'm reading this chart right, you're saying that the monthly employee will pay $386 a month for health insurance,
And they're paying 186 now.
and they're paying 186. So you're $200 a month increase.
Right, that's what I
They
was,
haven't had a pay increase in 10 years. And you're, I don't know. I'm at a loss for words.
You can hold it right there if you would, please, press. Mr. Chairman, we do not know until Friday what the county contribution truly could be.
that's right.
Today's task is right here on this agenda.
right.
Can we finish it?
Yeah.
And hold off on the county contribution equation until Friday, when we see numbers?
I
Go through the exercise you just,
I agree. I agree. I think it's important to hear from our department heads, but I agree. I want to know how it's going to affect y'all. And we just heard how it's going to affect you.
Thank you very much. I appreciate your time.
Mr. Chairman, if I might, if we can get input from Ms. Allen as to when the very last date is that you need to have rates locked down?
Thank you. Well, I would like to say that we talked at our last meeting that today was going to be our date. We've already made a decision not to use the online enrollment because we missed that deadline to input all that information. So we were hopeful to get a decision today, as was promised, so we can get all the open enrollment materials together, which is starting on July 15th and ends, July 17th and ends August 15th.
But I have to agree with Commissioner Lible. We haven't been told what the uptick was from Mr. Parker's office yet. We haven't done the plus and minuses through the budget where we're going to cut at as far as commissioners are looking at. We are requesting the revenues, and I think the big sheet of paper, we start going down Friday. And if we find $1 million, we'd be glad to put it onto there. If we can't find it, then we're going to be saddled with making a decision that's based on that final budget number at that point. So my question to you is, today's Wednesday. Is Friday going to make that big of a difference, or do we have to do something today?
Let me look to Marjorie, since she's okay with it. If I could make a comment as the HR director here, please.
Ma'am.
First of all, the HR department does not set the rates, and there seems to be some misconfusion with that. Otherwise, we wouldn't be sitting here today, because HR staff has to sit face-to-face with each of these employees and explain to them if there is an increase. So my vote would be to keep it exactly the way it is, but I'm hearing we cannot afford to do that. But historically, this has always been an administrator and budget office duty. We just implement whatever's given down, so I do have to address that. That is misinformation, and in the past, it's always been up to the administrator working it through budget. However, in years past, we had better years, and we had some rate reductions and renewals that were negative. Now that we're at a crunch, I know someone has to have the blame pointed at them, but it certainly isn't your HR department, and this is something that we're all in this together. And I will do whatever I can. I stated that during our committee meeting. We went out to bid like the committee requested, and I'm really glad we did, because we did see a rate savings at 3%. But we'll do whatever it takes. We're ready to hit the ground running, so appreciate it.
Thank you.
Also, we brought this to you last year. I saw, when I came to work here and looked at fund balance, an insurance fund that was in the negative, and rates that were being collected that weren't covering costs. And we had to do a budget adjustment last year to make the insurance fund whole.
You know, I remember last year, I remember getting the notice the night before the Tuesday meeting that our fund balance was in the negative and not in the positive, like we were being told it was going to be. And that caused a lot of confusion and upset in this chamber with our department heads. But now we've got that cleared up, and we're going forward at this point. There is no fund balance on the insurance fund, so that's over with. So these are true numbers. We're looking at what the actual is going to happen. But I really want to look at Friday, line by line, step by step. And if we can find extra money from other resources or whatever we got, and we can apply it to this to help soften that burden some, then I think our department heads and our constitutional officers will be ecstatic with that situation. So I agree. I think we need to wait till Friday, and Friday we'll have to make that decision. I mean, Friday's going to be it anyway. It's coming down to it. So we'll have that budget, and we've requested it a little bit early so we can look at it prior to getting there. So,
The budget itself will not be complete. I'm assuming then we're discussing general fund on Friday.
we're discussing
Because
$100.
it's going to take me through the rest of the weekend and into Monday to actually have a balanced budget ready for Tuesday.
I got you. Okay. So commissioners, let's withhold number 4, and we will bring that up on Friday when we look at all of our general fund and where we can cut more and where we can't cut more and what the uptick might be. Is that an agreement with everyone?
That's fine.
Okay.
We need to finish our business, though, we stay with status quo as far as fully insured or self-insurance.
Yeah.
Do you need a motion?
Well, we really
No,
don't.
if I was just going to say, I'm
We
sorry, I didn't mean to step on your toes. Put my county attorney hat on now. Just for clarification, for the record, hearing no motion otherwise, the most recently passed motion to accept Florida Blue's bid for fully insured still stands. There's no change to it other than what was offered up today as far as some additional coverage that they're going to provide under that plan.
Exactly. Okay, commissioner comments? Yes, ma'am? Well, we're kind of moving fast right now, so.
I'm sorry, I won't take much time.
You're fine.
My name is Vicki Whaley. I'm here on behalf of the Florida Sheriff's Multiple Employers Trust. I'd like to take just a moment to address the commissioners if I could. There's been some terms that have been flowing around about, and I feel like there's possibly some misconception when it comes to self-funding. Self-funding can be scary whenever you make that decision to go that path. But I feel like when you're being properly advised from an administrator who has an extensive background in self-funding, you'll see that there is a true benefit to self-funding, to both the plan and to the employees, because you then are allowed the freedom and the ability to customize your plans the way they need to be customized to address the needs of your employees without having to go to specific built plans within a carrier system. You also have the ability to build reserve over multiple years. I keep hearing this 50-50 chance whenever it comes to self-funding, and there's always a chance of risk whenever you're self-funded. That's why you have reinsurance. Reinsurance is there to protect you from that possible risk. But I also feel like if you look at your history and the amount of money that has been left on the table in a fully insured scenario of the amount of claims that have been paid versus the amount of premium that has been paid, you would see that the amount of funds that would have been left in reserve over that past 5 years would have been ample to put you in a different position that you're in today. So I would encourage the board to truly consider that leap of faith into going self-funded, because that you have to take that initial leap to take a long-term investment. Is it scary the first year? It is absolutely scary the first year. That's what reinsurance is for, and that's why you hire administrators and teams that are there that have the experience to assist you. I know that we submitted a bid whenever the RFP process was going through. I understand that the rates that were projected on our bid were not what we presented in our RFP, but I can strongly encourage you to take another look at self-funding, because you cannot continue to leave money in a fully insured area and keep leaving that money at the carrier's level.
You're
Thank
saying
you.
that your bid was not properly projected to this board?
My understanding was that the Florida Sheriff's bid that was presented to the insurance committee was rated at $7 million, and the bid that we projected, the bid that we submitted, was 5.
Thank you.
Thank you.
Thank you for your time. Okay, Commissioner comments? Commissioner Lible?
It's all been said.
Commissioner Goddard?
No, I have none.
Commissioner Pickens?
I do believe that the board definitely will consider the self-funding. I just don't believe it's the time to do it right now, especially with the risk, with no reserves. And then actually a little more education to the county commissioners and maybe even our employees of how the self-funding will actually work, so.
All right, thank you, Commissioner Pickens. You know, I agree. At a necessity, I think sometimes we should move. And I think this is a great time to go self-funded. But I'm in a team, and we're going to work together. And I appreciate honestly, all the hours we have spent going through this. It's been easier for me in some cases and more difficult. But it's a project that needed to be really vented well. And we're not done. Friday, we're going to see if we can find the extra money. I keep saying the bite of the apple was really big this year, and it was big. So maybe we can soften that bite up. If there's no other further comments or business before the board, this board will adjourn. Thank you very much.